Hey, it's Phil Ratcliffe with Rebel Financial, here to share with you our third quarter market update and kind of investment return and statement update. So, hope you are having a great start to the fall. I think what's on a lot of our minds is actually the market volatility and the downturn. And if you're watching this many months or years from now, you'll be like, what are they even talking about? It is possible that we won't even remember this in the future. But for now, we're getting a lot of questions. And you know what? That's normal. We've gone through a long period of time the last few years where we haven't had any significant market correction. And then, of course, when the volatility comes back, which is absolutely normal, we're just not used to it, right? And so we're going to talk about that, see where we are in the long term, etc. So I'm going to go ahead, share my screen with you so that we can make this a little bit more interactive. So you should be able to see my screen now. And really, you've probably gotten a notice as a client that you have new documents in your vault. And generally, we will upload your performance statement, your billing statement, because we want to be totally transparent with all of our clients. And then also the custodial statements from, TD Ameritrade and Schwab and Fidelity and TI Craft. So really, when you get those, you'll click on it, you'll log into here, go to your vault, and I'm just showing you our kind of handy dandy demo, John and Jane Doe. And then really, of all those statements, the most important ones are the ones that we give you. And then you'll go into here, I don't have this one updated, but you'll go into 2018, go to the third quarter, and then boom, you're going to have your statement there. You're going to click on it, and it's going to come to here. I do have a sample statement right here. So these are a compilation of a couple of our client accounts so that people can actually see, and I can use a demo one that doesn't actually have somebody's account number on there to illustrate and talk through a little bit about what's going on. You can get an update if you haven't had an appointment with me in a while. Or yours is coming up, or you're just concerned and you want to see what's going on, and you can see it right here, okay? And so you get the quarter, which, if you've been through many of these with me, you're used to me saying, skip this page. It's too short term. And we want to look at the whole year as our short term. So right now we're going from October 1st of last year to the end of the quarter, and you can kind of see the green line's the principal base, the blue line on there is how your account has changed over the time period, and the red line is the ideal. Again, if you could invest perfectly without any cost, what would you have made? And it's not a perfect proxy to how we're investing, but it's pretty close. And I don't know of hardly any other investment companies that are giving you a really good apples to apples comparison of how well am I doing versus an ideal for the amount of risk that I'm taking. So this is really good. And you can see over time, we track this really well. Even when you look at this long term right here, this is like 5 years worth of data. That's great. That's still not actually long term. We need to push to past 8 years, 10 to 12 would be ideal. So this is still an intermediate term, but you can see how well we're tracking that over the long term. There's going to be deviation because we do a couple things different, but we want to track that. The average investor does somewhere between 2 to 6% per year behind that. That's huge. And so our goal for our clients, once we start to get that 8-year data and more, is to be about 0.5% behind that after cost. And if we do that, that's really good. You're going to be like 90, 95% of all other investors out there on a risk-adjusted basis. And that's superb. If you've done a retirement plan with us and you look at what that upper side of the green when we turn the rate of returns up, doing that would hit the upper side of those returns for you. And if you've done that, you know that that's pretty phenomenal. That is a really good thing for your long-term financial planning, what you actually want to do with and how you want to use your money. And that's how we invest. It's not just to do good in the short term all the time because it's not really possible. And if you try to do that and that's how you measure, then inevitably that is part of the reason why people underperform. And it is even possible, and it happens to a lot of people, that when we call it chasing returns, you chase after those returns, that you can have catastrophic losses. And one of the reasons of how we invest, so you've probably gone over this with me, is we want to put your eggs in lots of different baskets. So in this person, they're kind of in between like aggressive and moderately aggressive. There's all their conservative bonds, and here's all the stocks inside of there. And then large and medium and small and international companies. And over time, whenever you see that we make transactions, we're generally buying low and selling high for you. And that means the things that are doing well. So, the last 3 and 5 years, our large growth has been one of our best. And if we hadn't harvested some of that growth, it'd be really huge inside of here. But we took from that, added some more back to the bonds and bought some international and some more value and small and medium sized companies. And, when things go down, it's good that we have our bonds because those are what protect us. And when things do go down, we'll take from some of those and buy these more on sale. When the markets are doing really good, just in general, we're going to take from all of these and lock some of the gains in over here. So that is a real high level. So you look over the last year, and this is pretty indicative. So, this is a TICREF account, and this is a TD Ameritrade account. With the IRAs, Roth IRAs, joint accounts that you may have with us or what, so we have a little bit more investment freedom. And so we do get your eggs into a good bit more baskets and are able to implement our strategy a little better. And one of those is to have a little bit more in emerging markets and not to currency hedge. So not to pay extra costs for insurance against the dollar going up. And of course, the dollar has done really well. Well, the last 10, 5, 3, and especially the last couple of years. And so that has kind of been a headwind. And you can see that here, whereas we can't really do that in the university and the 401k accounts as much. You can kind of see that was a little bit of a drag on us there. And that does explain a little bit of that. And you can see we were behind. For most of the year, we were actually ahead, but really when the trade war rhetoric kind of sped up, especially against China or what, so you can kind of see that deviation. That's exactly what that was. This is when the markets in general got spooked a little bit for the trade war uncertainty. This is the end of the Trump rally. I know a lot of you don't like the name, but it's just kind of what the media has dubbed it. So I just want us all to be on the same page when we're just talking about history. And then we've been going sideways, and we've just kind of got hit a little bit more than not because we got a little bit more emerging markets than the standard index that we compare against. And the dollar's done kind of well, and the index is just based in US dollar, whereas we've gotten a little bit down because of that. But the goal is we want to keep your costs low. That is another expense. And then it also gives us something to rebalance against. So when things do change over time, we do want to buy low and sell high. And that gives us another opportunity to do that for you. So in this example, these are a couple of accounts from clients that have been with us, one of them since the inception, and another one a year and some change after we started. That's what you can see. That's that rollover later on. And so you kind of see where we had that big 20% correction at the beginning of 2016 when the world was worried we were going to go into a global recession. And we got a little bit behind then, and we bought low. And then as things recovered, you see we got back in it and actually ahead of the markets. And now, again, we're kind of getting behind. And it's normal. It gives us opportunities to buy low, sell high. Even when we're doing good, we were taking money off the table in December of last year, in January, beginning of this year. And now we've been triggering to kind of buy low on some of those international things. And it's nothing to worry about. So you can see in this example, these are actual accounts. This client has made, somewhere between 6 to 8% with us when you mix it together, about 7% per year, versus the market at about, 7.7% per year. So, we're a little bit behind. But again, our goal is to be a 0.5% per year behind. And just recently, in the last couple quarters, we probably got, depending on if you're aggressive or conservative or somewhere in the middle, somewhere between, we probably lost just in the last couple quarters versus the index 2 to 4%. So in this case, that's almost the entire thing, and we're still about where we promised our clients that we're shooting for, and that is the high side of your plan. So while it may seem sometimes that you're not accomplishing your goals, we got to remember we want our eggs in different baskets because we don't know what's going to happen in the future. And if you try to bet, I have some people come in and say, well, the NASDAQ did this the last year and we only did that. I'm like, well, the NASDAQ is pretty aggressive. It's just large growth companies in the United States. And, you're moderate or moderately aggressive. You have bonds, and we have international and small companies. And all of those things did well behind that. And if you rewind the clock back 18 years when the tech bust, happened, the NASDAQ was down, like 80%. We don't want to have all our eggs in one basket. It is tempting sometimes to say, well, if I would have done this, I would have made this much. But that's not our goal. We want to make you a good long-term rate of return of somewhere between 6 to 10% per year, depending on how conservative or aggressive and when we're going to use your money. And this statistically is the best way to do it. We don't want too much in large growth, but as you can see, it is one of our biggest pieces of the pie. We want to have a little bit of value bias because when we look back over the last 100 years of longer time periods, value beats growth. Smaller companies generally beat larger companies, and that value premium is 1 to 4% per year. And so when we're doing these things, we're trying to help our clients stay disciplined on the long term. We're not necessarily betting on the future. We are just strategically making sure that we stay disciplined to not fall in the trap of jumping on the bandwagon to only invest in what's done well. So those are your statements. We're very happy with performance, even though we don't like it either. When there's a lot of volatility in the short term, we lose. But again, we have our eggs in our basket. That's going to give us an opportunity to buy low. We have a good strategy for the long term. It's very balanced, and almost conservative in the fact that we aren't, trying to call what's going to happen in the future. I just posted something to Facebook. You can check it out. That says it's a great actual article from the American funds. They call this website the Capital Ideas, but it goes through and it talks a lot of great things and shows you the actual science and the market history behind why do we invest for the long term, and how do we deal with and understand that there are going to be market declines, and that we as human beings are loss averse. We don't like to lose. It hurts us more than when we win. And we have to just understand the facts and control that about ourselves so that we're not that person underperforming the markets by 4 or 5% per year, because we made, either fearful decisions at a certain point or greedy decisions when things are going great, the opposite way. And so if you just read through this, great information, and really talks you through why don't we time the markets? Why can't we just pick the good times to be in and miss the bad times? And what's the effect of that? I mean, it's huge in terms of how much gain a lot of people lose. And then what's the actual, how often do these big downturns happen? Every year to 4 years, you're going to have multiple of these, and then it's normal. It is normal, okay? It's not something that's atypical. It's just sometimes we get into these good times that it doesn't seem like that. We look at things right now. I mean, stocks across the world are pretty fairly valued. The U.S. market's a little bit higher. It's been doing better than everything else, but let me skip down here. When we look at the world, you can see, developed markets around and emerging markets are well below long-term averages. And so there's some absolutely good deals and values out there. And when we look at, people say, well, it's time for a recession. Yeah, we're getting along in our cycle. You can see all the past cycles, but look at our cycle. Look how much slower it was than all these other ones. And in that case, it's not out of the question that you could have a longer up just because we haven't gone as high up as we've recovered, as in the past. And we've had corporate tax cuts. That's another one of these charts inside of here. You can see, yeah, I think this will higher here. You can see that we went, you can see that we went from the highest corporate tax rate in developed nations, to somewhere around the middle. That's going to be good for business and so on. That's what we're investing in when we're investing in the market. So that will probably be good for things continuing to do well. The other thing is that, Europe and Asia aren't as far through their cycle, and we could absolutely kind of ride their coattails. The more short-term uncertainty with the trade war uncertainty, I mean, Europe's kind of made a deal with us. So is NAFTA. I imagine after both China and Trump can collect their political points, they'll make some kind of deal as well too. So I mean, in that respect, it's not the end of the world. We will have a recession. It's coming sometime in the next few months to a couple years, but that's okay. The markets go up. We'll harvest some of that growth and lock it back into the conservative. If it happens soon, we've already harvested a couple times and put some into bonds. It'll go down, and then we'll buy low, and then things will turn back around again. That's just the way that it works. It's normal. We are happy with the investment returns. Take a look at this Capital Ideas article, either from the link below this video, or go check out our Facebook and look at it. There's also another piece in here where you can click to their Volatility Center, where they've got lots of little things to talking through. How do you deal with this? What's causing this? Actually, this gives us opportunities a lot of times to accentuate our rate of return, if we're long-term investors, because it will give us opportunities to buy things on sale. So again, I want to thank you for being a great client of ours. We enjoy serving you, having the opportunity to make a difference in your life, in making that better investment rate of return, but even more than that, to make these investments work for you so that you're going to have a successful retirement, be able to accomplish the goals that you want to, help the people and organizations that you want to. So again, thank you very much for your time. We appreciate being of service. As the markets are volatile, you can always be assured because we have discretion, we'll buy low for you when things have already been high. And if they continue to go back up again, we'll harvest some of that growth for you and lock it in so we're not letting it ride. So we're here to work for you. I know it's hard sometimes to look at things and that it's not always up, but it is kind of the nature of investing, and it is normal. So anytime you need anything, you're worried, you have questions, you give us a ring. Otherwise, I hope you have a great start to fall. Happy Halloween, and we look forward to seeing you at one of our events or at your next review. See you then.